For decades, the global public was assured that American debt instruments represented the ultimate risk-free investment on Earth. Indeed, these securities formed the absolute bedrock of our international financial framework. But an unexpected shift recently threatens to shatter that entire narrative. This development directly violates the established protocols of the macroeconomy established after the Second World War. Surprisingly, the specific banking organizations designed to hold these bonds are rapidly offloading them. If you observe the major monetary authorities closely, you will see warning signals indicating deep distress. They are accumulating historic volumes of bullion, rejecting American government paper, and developing transaction networks that bypass Western clearinghouses. Just days ago, the European Central Bank validated a trend we highlighted for a long time. In a monumental shift, physical precious metal reserves surpassed US government bonds for the first time. Understandably, average citizens will observe this massive development and mistake it for a simple, meaningless fluctuation in physical commodity valuations. Granted, the yellow metal experienced 100% price appreciation recently, but this underlying shift is far more profound. You must query why the actual sovereign entities in charge of issuing paper money and backing up national wealth are prioritizing tangible assets over the very foundation of current international commerce. What hidden insights guide their strategic decisions? What disruptive events are they anticipating? To unpack this mystery, we must trace how American debt secured such absolute power and what broke. For nearly a century, no viable competitor existed. The contemporary economic architecture relied solely and completely on the dominant American greenback. Global trading partners gathered greenbacks via industrial manufacturing, and petroleum transactions occurred in American currency, cementing a highly effective, self-reinforcing economic cycle. Increased worldwide circulation of greenbacks expanded treasury ownership, making this currency irreplaceable, solidifying American debt as the premier global reserve instrument. This established U.S. bonds not merely as a standard portfolio option, but as the benchmark store of value, which explains why current market actions appear so bizarre. Ostensibly, nobody can dispute that the dollar remains highly influential, or that treasury notes remain the deepest pool of national wealth, yet foreign sovereign institutions relentlessly buy gold. If these paper instruments are so secure, what triggered this historic shift? For a long time, Western sovereign debt has slowly lost its luster as a treasury holding due to several critical factors. The foremost issue is a hidden bankruptcy. Unlike a standard default, where a government outright refuses to meet its financial obligations on due dates, a hidden bankruptcy occurs when basic economic equations fail. It manifests when national deficits outpace productive output, prompting severe scrutiny from global markets. Imagine you purchase treasuries generating a return of under 3% annually. Meanwhile, total liabilities swell while living costs rise by 5% annually. You receive your principal back in raw numbers, but your actual purchasing power has completely evaporated. Previously, global governments tolerated this silent wealth destruction because these securities offered truly unparalleled liquidity, massive scale, and total safety. But what happens when that perceived safety turns out to be an illusion? As international anxieties intensified, a secondary indicator of systemic decline emerged in the bullion sector. Traditionally, public asset managers acquired minimal physical metals, yet a massive, unprecedented pivot transpired. Reserve institutions secured thousands of physical metric tons. They repeated this massive buying spree during subsequent periods. The current year registered the highest transaction volume in modern human history. Remarkably, the fiat structure faced no immediate catastrophe. The dominant currency retained its throne. What fundamental truth did these policymakers grasp? Or what structural shift occurred to alter their reserve behavior so dramatically? When considering American global hegemony, what specific elements arise? Most citizens immediately envision advanced weapons, hypersonic missiles, or heavy military armor. Yet, the preeminent instrument of raw force deployed by Washington is actually their domestic currency. This represents a quiet, imperceptible financial device capable of neutralizing almost any foreign adversary instantaneously. Recently, the Western coalition orchestrated severe economic penalties following geopolitical escalations, confiscating substantial capital wealth of a sovereign nation instantly. For the first time, the administration completely immobilized another major country's foreign state funds. Do you realize the terrifying precedent this sets for every sovereign nation holding Western paper promises? Consider this analogy. There is a huge difference between a borrower refusing to pay your interest versus a custodian refusing to return the capital you entrusted to them. However, in this scenario, they went straight into your private safe, breached your residence, and confiscated your own accumulated generational prosperity. That is the reality. The signal transmitted to global policymakers was unmistakable. Your national savings do not genuinely belong to you. They lack genuine neutrality. They will be seized instantly if the global hegemon disputes your policy choices. Prior to this dramatic foreign asset confiscation, global monetary authorities were already deeply doubting American reliability and analyzing whether accumulating more government liabilities remained logical while the international economy faced astronomical systemic debt levels, soaring retail prices, and miserable yields that totally failed to compensate for rising geopolitical dangers. Put simply, the structural pillars supporting the world fiscal apparatus had been showing deep fractures for a long time, but recent global events acted as a massive accelerant. This leaves us with a central question. Why did these highly diverse sovereign institutions, while fleeing sovereign treasury notes, select the exact same refuge? Why did they flock so heavily into a single market instead of diversifying across other fiat paper currencies? It certainly was not a coordinated global conspiracy where banking officials gathered secretly to target this specific asset class. No, the actual motivation runs much deeper. Many mainstream analysts assert it is simply the traditional flight to safety during times of macroeconomic crisis. While partly true, that explanation completely misses the grand picture. Some argue that market price momentum and fear of missing out drove their purchases, but that theory crumbles upon analyzing their execution strategies. Interestingly, monetary authorities bought physical metals aggressively at unprecedented historical price peaks. Furthermore, they kept purchasing even when the market cooled down. This proves it is not a short-term speculative paper trade. Ultimately, central banks are executing a massive multi-decade transition. They are preparing for a systemic paradigm shift because physical metal represents a unique monetary reserve that completely avoids any form of third-party default risk. To clarify, American Treasury notes or any alternative security resting within our established monetary framework depend entirely on foreign promises and administrative choices. You must place your faith in a foreign issuer. That is the definition of sovereign default vulnerability. Conversely, tangible gold, when held within your personal direct storage or kept in your personal control, which applies equally to major institutions and private citizens, belongs fully to you without dependence on external counterweights. Owning tangible wealth detached from this matrix is absolutely critical as the foundational economic systems start deteriorating. Will you protect your family and wealth? If you examine the macroeconomic landscape from a broader perspective, you will observe that our global financial network rests on liabilities, leverage, and unbacked commitments. It represents a massive, fragile matrix where monetary authorities face an impossible choice between preserving banking structures or defending currency purchasing power. History proves that every paper currency ever issued has ultimately perished miserably. Without exception, every unbacked legal tender has devolved to its true value, zero. Paper currency eventually returns to its intrinsic physical value of zero. When analyzing these monetary collapses across centuries, which anchor do administrative rulers inevitably resort to during a systemic failure? The historical resolution remains entirely identical. Governments always adopt physical, tangible gold bars. Why is this single ancient asset always the final lifesaver? The actual revelation from the central bank study goes far deeper than simply crowning gold as the premier asset. The real emergency is what dropped to the second tier: American government debt. Every sovereign nation across the globe remains heavily exposed to these securities and the greenback. I am not forecasting an immediate currency implosion, but I am highlighting that monetary leaders are explicitly organizing for an alternate global structure where Washington does not dictate the terms. As this massive emigration from American debt accelerates, the collateral damage will spread globally. Rising yields will break treasury budgets, and budget failures will destroy the currency value. Are you prepared? Consequently, if policymakers persist in issuing unbacked capital while facing dwindling market demand, public borrowing costs must inevitably surge to attract investors, which means real purchasing power completely collapses for every standard cash deposit and dollar-linked financial asset worldwide. They will depreciate significantly, hurting every average household on this planet. Domestic citizens will definitely experience this severe pain. Yet clients frequently ask me, what about other developed nations like Canada? What about Europe? Are alternative government papers safer than American greenbacks? My genuine perspective is that our global economic network is completely bound together, and if you operate inside this greenback financial system that currently dominates human commerce, you cannot escape the fallout. Central bankers are openly signaling that they are definitely not seeking refuge in alternative paper fiat tender. They prefer physical and tangible reserves. Watch carefully. They are not transitioning towards some alternative fiat reserve unit. Instead, they are reverting to the single tangible holding operating entirely detached from national political systems for millennia: real, physical gold. The parameters are shifting. If you monitor Beijing's strategic creation of new commodity exchange pipelines, sovereign transaction processing structures, and regional logistics distribution networks designed to anchor physical gold and silver trading globally, you realize the sheer magnitude of this historic transition. While the future global monetary framework remains completely undefined, it is certain that physical precious metals will definitely constitute the absolute core of the upcoming new international economic architecture. Reviewing these fundamental elements together, the logical arguments against unbacked paper cash versus the security advantages of holding tangible assets are exceptionally obvious. Don't listen to what they say, watch what they do. I completely ignore the reassuring public statements of national regulatory authorities. Instead, I closely observe their specific asset transactions. If the exact global organizations that actively issue the paper tender are frantically panicking to acquire physical bullion, that indicates exactly how I must secure my own family's financial wealth. If you have not established a highly structured precious metals accumulation plan, you must act immediately today. As the global monetary recalibration continues to accelerate, the cost barriers to convert your paper cash or other declining fiat units into physical metals will become completely astronomical, locking out citizens forever. Now, on our channel Hassan Ali, we work tirelessly to cultivate extensive macroeconomic awareness and asset preservation resources. This represents our core mission. We provide financial analysis, but we offer so much more than standard reports. We assist in formulating personalized wealth strategies for our audience members that are designed specifically using these historical patterns we meticulously examine. These economic cycles repeat continuously throughout history. If you interpret past monetary structural resets, you can analyze contemporary developments and position yourself ahead of the curve. If you wish to connect with me directly, a real strategist who can assist you in safeguarding your financial future, please check the links within our video description, where you can arrange a personal consultation session at your convenience, or simply join our private educational community. If this information proved valuable, kindly forward it to family and friends. We hear constantly from our community that they have people they care about who remain completely oblivious to these tectonic macroeconomic shifts. If you want to help them protect themselves, please make sure to like this video and subscribe to our channel, Wines of Thought. Doing so truly amplifies our educational reach. Until next time, I deeply appreciate your presence here. I am Hassan Ali, representing Winds of Thought, your dedicated guide for sovereign survival, asset protection, and generational wealth security. Stay strong.